Right, well, data out this morning offered much needed clarity on the state of labour, with the job openings falling below 10 million for the first time since 2021. With a look at what this means for the wider labour market, I'm joined by Nick Bunker, Head of Economic Research at Indeed Hiring Lab. Good to have you on, Nick. So as we look at this JOLTS data that came out this morning, job openings falling, decreasing to 9.9 million, quits edged up, layoffs and discharges, though, decreased a little bit. How would you characterise the state of the labour market right now?
So we're still in a very hot, a very strong labor market, even if there is easing demand for new hires. That's why you're seeing the job openings number come down and why quits has moderated over the last year or so. But as you said, layoffs are still quite low. In fact, they're still still below their 2019 average back of 1.2%. So we're seeing a labor market where employers are adding fewer workers, even though unemployment is still low and layoffs are still dormant for the most part. So I think this is one where folks can expect to hold on to their job, but maybe not find one as easily as they were last year.
And it is worth noting that clarity there, because obviously a lot of these tech layoffs get the biggest headlines. But when you look below the surface in the Indeed notes, you have that total monthly layoffs are actually about 16% below the pre-pandemic average. So which sectors then are seeing the strongest demand for employees right now?
So I think there's two broad sectors that are seeing demand still elevated. One is a lot of these in-person lower wage sectors that got hit hardest by the pandemic, but are still rebounding from that. So think about accommodation, food services, bars, restaurants, hotels. Demand's still strong there. You're also still seeing some relatively strong demand in some sectors like transportation and warehousing and utilities. There's still some underlying demand, even if things have moderated there a little bit. And I think, as you said, the tech sector gets a lot of attention and press, but it's definitely not representative of what we're seeing overall in the U.S. labor market right now.
And something that was interesting that you noted, the benefits and perks, usually that's a way for employers to sort of, entice employees to come in. But you're seeing that the data showing that advertising those benefits has leveled off. What does that signal?
So I think it signals that not only are there fewer opportunities out there for job seekers to find a new job, but the competition that employers are going through to fill those positions is moderating as well. Like you said, these sort of benefits or non-cash benefits of jobs. Employers seem to be using them to sort of attract folks to apply for their job, to compete for those new hires. And while they haven't reversed, the rate at which they're advertised has slowed down, suggesting that employers are feeling less of a need to sort of advertise the benefits of their job in many ways in order to get folks in the door. So while that demand might still be strong in, say, a quantity measure, if you look at some of these other attributes, things are moderating a bit more than that headline number would have you believe.
So then what does that mean for the wage growth picture? You have the nominal wage growth versus the real wage growth, which accounts for inflation. We did see some softening there. Is the bargaining position of some of these employees starting to shift then?
It is. So not only do you see, wage growth is moderating. We're seeing that in a variety of metrics. I think one measure that came out this morning that's quite relevant for that is the quits rate. Most of the time when people are quitting their old job, it's to go ahead to a new one, and they're getting a raise for doing so. And one thing you can see in a couple of statistics is that the gains to switching jobs have moderated over the past several months, suggesting that people might be switching jobs still at an elevated rate compared to 2019, but they're not getting the same sort of wage boost that they were late in 2022, late in 2021 or early in 2022. So that there is some sense that likely we'll see wages continue to moderate, but they're still growing quicker than they were back in 2019. So at least in nominal terms, wage growth is still strong, even if it's starting to cool off.
And something I want to look at, obviously, we've been talking a lot about recession this morning, recession fears, whether or not that would spur more people to enter the job market. And the employment to population ratio for workers aged 25 to 54, that's usually a good gauge of the health of a labour market. That stood at 80.5% in February. But if you're a new person entering this market, obviously graduation season coming, what sort of labour market are they walking into?
So I think if you are, say, it also I think depends on sort of where you're graduating from. So if you're a college grad, things might not be as rosy as they were, say, last year, particularly as we are seeing some of the pullback in job postings, at least on Indeed, tend to be for these more higher wage in office or remote work type jobs that might be a stepping stone for folks who are just graduating college. Now, it's still like strong compared to 2019, but not quite last year. But I think if you're, say, graduating from high school, want to enter the workforce right away, labor market's still really strong. There's still lots of opportunities out there, and wage growth is quite strong there as well. So I think compared to, say, graduates of 2009, 2010, things are much stronger. But I don't think for many folks entering the labor market right now that things are going to be as opportunistic as they were back in 2022.